All around the world, live game streaming has picked up steam and two companies have gotten almost complete hold of the game streaming market in China. The names of those two companies? DOYU and HUYA. There are a lot of reasons why I believe that both of them are amazing investment opportunities right now. If you want to find out more, stick around and please smash that like button to help out the channel. There is one thing that you need to know about the game streaming market. China will dominate it. At least, that is the message that all the market research platforms give off. The Chinese game streaming market is currently valued at $4.6 billion and expected to grow by 32% next year. DOYU and HUYA currently control 80% of that game streaming market. 80%. It is literally a monopoly. And if you follow Warren Buffett, you know that you should always buy companies that run a monopoly. In fact, the two companies were going to merge earlier this year, but last week on 12th of July, DOYU and HUYA officially announced the termination of their merger agreement. The merger was blocked by the Chinese market regulators based on antitrust grounds, essentially meaning that DOYU and HUYA would become too big. The whole merger was orchestrated by Tencent, which holds a third of both companies. Tencent has been running into some issues with regulators lately, so it is possible that this was another reason why the merger did not happen. Personally, I don't think that this will affect DOYU and HUYA too much. However, we have seen a massive drop in their stock price as a result, which is good. It's great. Why? It creates the perfect buying opportunity. Warren Buffett always says that you should buy when others are afraid, which is precisely what is happening right now with HUYA and DOYU. Investors are afraid, but the fundamentals of both companies have remained the same. The long-term prospects are the same. Let's take a look at them. First off, we've got the monthly active users. In 2020, both companies saw a big surge in users, so it was expected that there will not be much of a growth in 2021. Looking at HUYA, we can see that this was accurate. Their monthly active users increased by less than a million, from 74.7 million in the first quarter of 2020 to 75.5 million in the first quarter of 2021. Their paying users actually dropped from 6.1 million in Q1 of 2020 to 5.9 million in Q1 of 2021. However, DOYU actually managed to grow their user base by 21.3% from 158.1 million in Q1 of 2020 to 191 million in Q1 of 2021, although they also saw a drop in paying users from an average of 7.6 million in Q1 of 2020 to 7 million in Q1 of 2021. Both companies attributed this to the economy returning to normal, which was expected. Did this affect their revenue though? Did they see a drop in sales? HUYA actually saw an increase of 8% in revenue to $397.6 million as compared to the same period last year. Their live streaming revenues rose 5.2% to $365 million, and the ad revenue went up by 54.6% to $32.4 million. You can tell that they have started to monetize using advertisements. HUYA's earnings also went up 8.4% to $28.3 million as compared to last year. They also had a positive net cash flow of $25.4 million, which is not huge, but it is good to see that they are keeping a positive cash flow. In comparison, DOYU saw a big drop in earnings from a profit of 254 million Chinese yuan in Q1 of 2020 to a loss of 102 million Chinese yuan in Q1 of 2021. This was combined with a 5% drop in revenue, but I'm not really worried. Why? Simple. DOYU's user base is growing fast. The company is still in the early stages of monetization, and right now it is more important to maintain and grow its user base. They have 2.5 times the users of HUYA. As long as they maintain that leadership, DOYU will do fine. There is another reason why. Right now, DOYU is sitting on a cash equivalents pile worth $1.2 billion, while they trade at a market cap of almost $1.44 billion. The company has more than enough cash to sustain its operations, and this tiny loss of about $15 million this quarter is nothing. They have less than $10 million worth of current and long-term debt. This also means that they have an enterprise value of $240 million. Their revenue for the last 12 months was almost $1.5 billion, meaning that their EV to revenue ratio was only 0.16. 0.16! This is extremely cheap. If the company drops a bit further, they will literally trade for the cash on their books. they will essentially be a free company. When we also consider that their forward PE for 2022 is 17.8 and their price to book ratio is 1.36, we can tell that Douyu is a bargain right now. Douyu is currently trading for $4.45. It has literally never before traded that low. The discounted cash flow model from Finbox gives us a fair value of $9.07, while Simply Wall Street uses the free cash flow of Douyu to estimate a fair price of $16.13, which is over 360% upside. It obviously depends whether you want to be conservative or optimistic, but I personally think that Douyu can hit $16, although it will take at least a year. If it sounds too optimistic for you, bear in mind that the average analyst price target is $11.12 according to Yahoo Finance. This is real! Plus, Douyu still has an insider ownership of 22.5%, which means two things. One, the management is invested in the company and wants to see a higher stock price. Two, it can lead to a massive price boost later on when institutions buy in. Douyu has also reduced the amount of shares outstanding from 334 million in 2020 to 321 million in 2021, which also improves the company's metrics and makes it more attractive to investors. What about HUYA though? Are they also a good deal? Absolutely. Despite having less users than Douyu, HUYA is generating more revenue and earnings. They have higher margins due to better operational efficiency. Essentially, HUYA is one step ahead of Douyu in terms of monetizing and optimizing their business. Plus, similar to Douyu, HUYA owns a lot of cash equivalents, about $1.6 billion on a market cap of $3.35 billion. Their total debt is also around $10 million, meaning that their enterprise value is about $1.75 billion, or half of their current market cap. Over the last 12 months, they made about $1.7 billion in revenue, so their EV to revenue ratio is 1, which is extremely cheap. Their PE is 24.5, their forward PE is 14.9, and their price to book ratio is higher than Douyu's at about 2.2, but it is still cheap. HUYA is currently trading for $14.4, and the last time that HUYA traded this low was during the COVID crash in March 2020. The discounted cash flow model from Finbox gives us a fair price of $40.3, while Simply Wall Street values HUYA at $17.6, but I personally think that the higher valuation is justified given HUYA's past record and potential. Analysts also expect a higher target price of $22 according to Yahoo Finance. We can easily achieve a 50% upside in the next 12 months and perhaps over 100% after another year. There are two main risks involved with Douyu and HUYA. One, it is the fact that Tencent owns a third of both companies. Having such a massive stakeholder owning two competitors is a red flag. Tencent will not be able to merge the two companies now, so it is likely that it will sell its position in one of the companies and focus on the other, driving one share price down and another up. Also, we have the risk of regulation. Right now, neither company has faced regulatory issues on its own, but Chinese regulators could interfere if we see a massive expansion or anti-competitive practices. I don't think that this will happen anytime soon though, but it is something to watch. Finally, seeing companies that are this undervalued is a red flag. Typically, I would agree. However, both HUYA and Douyu are leaders in the game streaming market. They have a massive presence, they are still growing, they have massive cash stockpiles to ensure that they can continue their operations. They are either making a profit or close to doing so. Their price crashed because of the events and fear around them, not because they are underperforming companies. This is not a financial advice, it is just my opinion, but both of these companies are strong buys in my books, with Douyu being my favorite. I own both of them and I plan on buying more while they trade at such low prices. What do you think? Are Douyu and HUYA worth it? Let me know down below. Also, check out my video of Baidu, another solid company and a favorite of mine. If you enjoyed this video, please like, share, comment and subscribe. Thank you for watching and I will see you again soon.